Market wants a rate cut, but honestly, the market's already got it priced in. So it's much more about the path forward from here. Our base case is maybe we get another one, two as a stretch assignment rate cuts in the new year. But I think the market is maybe particularly interested in what the Fed says today about the liquidity profile of the market. Are bank reserves too low? What are they thinking as it relates to QE or maybe a QE light kind of program? Some of those other topics I think are going to be more important today in terms of the market's path forward than just 25 bips.
So if we do get 25 basis points today, maybe one, maybe two rate cuts next year, where's the opportunity for PNC Asset Management in 2026? Because we've had a really solid 2025 in both stocks and bonds.
We sure have. It's been a very, very successful year. We'll take it. Somewhat unexpected, I think. I mean, we thought it was going to be a good year. We didn't think it was going to be quite this strong. But again, this is an easy place to be wrong on when you have such strong market returns. We think next year is going to be another positive year, a little bit more muted. That's not saying too much given returns this year, but a little bit more muted next year, really because we think the purple haze of policy uncertainty is going to continue to dominate next year. Midterm election year, notoriously difficult for equity markets. So I think it's going to be a choppy kind of policy noise driven sort of a year, but the underlying fundamentals are so strong that by the end of the year, I think we're going to be in strong positive territory.
The heritage Amanda Agati of PNC Bank is, of course, Stuart Hoffman, and really grounded economics. Do you buy the 3.5% run rate on GDP we see out of Atlanta Fed right now?
Well, we certainly have gotten better than expected results really over the course of this year. The Stu Hoffman or the house view in terms of the economic forecast for next year is a bit slower on a relative basis. We're not talking recession. We're not even talking flatlining in terms of growth. But I think there is a little bit of a moderation in terms of that growth rate that we would expect to see next year. The wild card is going to be policy, though. There's a decent amount of stimulus from all of the good things that happened over the course of this year that are going to come home to roost next year. And so it could actually be an upside surprise. We just haven't seen a lot of that flow through yet. So I think it's going to be another solid year. We'll call it good enough from an economic growth perspective.
That's the theme of the show, call it mid-November to now, is everybody saying we're going to get a policy pop.
Yeah. With the one big, beautiful bill, we'll see how it ripples through the economy. Amanda, in the bond market, boy, 2025, you had solid high single-digit returns in the bond market here. How do you think about 2026? Because I can sit here at a 2-year treasury and clip 3.6% coupons. Do I need to take credit risk on top of that?
Well, if the backdrop continues to hold up as it has been, and again, we think next year is going to be a good enough kind of a year, I do think that there is an opportunity to take on some additional credit risk. The challenge has been for the last few years that spreads have been so tight, aka valuations have been pretty high. And so there's not a lot of room there with spreads as tight as they are and as well behaved as they are. That's the good news, that we don't see a big default cycle kind of kicking off here. But I think there's room for investors to take on some credit risk in 26.
Can I go nerd as we close this out?
Absolutely.
Amanda, I'm looking at the employment cost index. Cy, thank you so much. Cy leans on the employment cost index. It's wages and benefits sort of summed together. Year over year, we had a buoyant 5% ECI, really big wage and benefit growth. And come on, Amanda, we've come halfway back now to year over year 3.5%. Is the surprise for next year a negative real wage?
Oh my goodness. I hope that's not the case, because that's going to spell trouble certainly for the labor market and the consumer. I mean, you have to wonder how you keep up this pace, right? At some point it has to kind of moderate, but a negative real wage is not going to be great for consumer spending and consumer growth. The consumer's been hanging in there, but it's really because of what you just said: wages, benefits. The labor market's been hanging in okay. To the extent that we start to see that reverse, I think that could be a wild card to the downside for next year. That's not in our base case, but certainly something to watch.